Most retirees never see it coming. They spend decades preparing for retirement, but almost nobody prepares for what happens at 73, because one government rule quietly begins that year. And by the end of this video, you'll understand why I call it the retirement triple tax bomb, and what many retirees do years beforehand to reduce its impact. Part 1. The birthday nobody warns you about. Retirement is full of milestone birthdays. At 62, you can claim Social Security early. At 65, most Americans become eligible for Medicare. And depending on when you were born, your full retirement age is somewhere between 66 and 67. Those birthdays get plenty of attention. Financial advisors talk about them. News articles cover them. Friends and family ask when you're planning to claim your benefits. But there's another birthday that often gets overlooked. Age 73. And for many retirees, that's when the tax picture can change almost overnight. To understand why, we need to go back to the day you first started saving for retirement. If you've spent years putting money into a traditional 401k or traditional IRA, you probably enjoyed one major advantage along the way. In many cases, you received a tax deduction when you made those contributions, and your investments were allowed to grow tax-deferred year after year. That's one of the biggest reasons these accounts have become so popular. But there was always one important condition attached to that tax break. The IRS wasn't saying you'd never pay tax on that money. It was simply allowing you to postpone paying it. Eventually, the government wants those deferred taxes back. And for many retirees today, that process begins at age 73 through something called a required minimum distribution, or RMD. Put simply, once you reach that age, the IRS generally requires you to start taking money out of many traditional retirement accounts each year, even if you don't need the income. At first, that may not sound like a huge problem. After all, you take the withdrawal, pay the tax, and move on. But that's where many retirees get caught off guard. Because that required withdrawal doesn't just create one tax bill. It can quietly affect other parts of your retirement that most people never think are connected. And that's where the retirement triple tax bomb really begins. Part 2. The withdrawal you can't refuse. Let's start with the first part of the retirement triple tax bomb, the required minimum distribution, or as it's more commonly called, the RMD. If most of your retirement savings are in traditional accounts like a 401k or traditional IRA, the IRS generally won't let that money stay there forever. Once you reach the required age, you're expected to begin taking a minimum amount out every year. And here's the important part. It doesn't matter whether you need the money or not. You might have other savings, you might have a pension, you might already be collecting Social Security, you may not want to touch your retirement account at all. But the IRS still expects you to start withdrawing from it. The amount isn't the same for everyone. It's based on factors like your age and the balance of your retirement account. So the larger your account has grown over the years, the larger that required withdrawal may be. Imagine you've saved $800,000 in a traditional IRA by the time you turn 73. Your first required minimum distribution could easily be around $30,000. Whether you plan to spend that money or not, it's now added to your taxable income for the year. For many retirees, that's the first surprise. They spent decades delaying taxes while they were working, only to discover that retirement doesn't always mean choosing when to pay them. Sometimes, the choice is made for you. But here's where things become much more expensive, because that $30,000 withdrawal doesn't just affect your tax return. It can also increase what you pay for Medicare. And that's the second part of the retirement triple tax bomb. Part 3. Tax number 2, the Medicare surprise. Most retirees assume that once they enroll in Medicare, their monthly premiums are set. But that's not always how it works. Medicare doesn't just look at your age, it also looks at your income. And if your income rises above certain limits, you could end up paying more for your Medicare coverage. This is known as the Income-Related Monthly Adjustment Amount, or IRMAA. Don't worry about remembering the name. What's important is understanding how it works. Imagine two neighbors who are both 73 years old. They have the same Medicare coverage. They go to the same doctors. They receive exactly the same benefits. But one of them pays significantly more each month. Not because they're getting better health care, not because they chose a different plan, but simply because their income was higher. And remember that required minimum distribution we talked about a moment ago? That withdrawal counts as income. In other words, money you may never have planned to spend can increase the income Medicare uses when determining what you'll pay. And there's another detail that surprises many retirees. Medicare generally looks at your tax return from 2 years earlier. So if your income jumps this year because of a large required minimum distribution, you may not feel the effect immediately. Instead, the higher Medicare premiums can show up later, leaving many people wondering why their costs suddenly increased. For some retirees, it's the first time they realize that one financial decision can affect something completely different. But the chain reaction doesn't stop there, because that same required minimum distribution can also affect how much of your Social Security becomes taxable. And that's the third part of the retirement triple tax bomb. Part 4, tax number 3, when your Social Security gets pulled in. So far, we've seen how a required minimum distribution can create a tax bill of its own, and how it can increase what some retirees pay for Medicare. But there's one more surprise. It can also affect your Social Security. One of the biggest retirement myths is that Social Security is always tax-free. In reality, depending on your total income, up to 85% of your Social Security benefits can become taxable. That's an important distinction. It doesn't mean you're paying an 85% tax rate. It means that up to 85% of your benefit may be included as taxable income when you file your tax return. Let's look at a simple example. Imagine a retired couple receiving $50,000 a year in Social Security benefits. They're also required to take a $30,000 required minimum distribution from their traditional retirement account. On its own, that withdrawal is already taxable. But because it increases their overall income, it can also cause a larger portion of their Social Security benefits to become taxable as well. Suddenly, that one required minimum distribution is affecting more than just one line on their tax return. It's influencing multiple parts of their retirement at the same time. And that's why I call this the retirement triple tax bomb. One IRS rule leads to a taxable withdrawal. That same withdrawal can increase Medicare premiums for some retirees, and it can also make more of your Social Security benefits taxable. 3 separate consequences, all starting from the same required withdrawal. The good news is that this doesn't happen overnight without warning. In fact, many retirees have years to prepare for it. The problem is that most people don't realize they should be planning for age 73 until they're already there. Part 5. What smart retirees do before 73. At this point, you might be wondering, is this inevitable? The answer is not necessarily. While everyone's situation is different, one of the biggest advantages you can have is simply knowing these rules before they begin. Because once required minimum distributions start, your options often become much more limited. That's why many retirement and tax professionals encourage people to start thinking about age 73 years in advance, not when the first RMD notice arrives. Depending on your circumstances, there may be strategies that help reduce the impact of the retirement triple tax bomb. For example, some retirees gradually move part of their traditional retirement savings into a Roth IRA over several years. Others choose to make withdrawals earlier in retirement, before required minimum distributions begin, rather than waiting until the IRS forces larger withdrawals later. Some people use qualified charitable distributions, allowing eligible retirees to give directly from certain retirement accounts to charity, which can help satisfy required minimum distribution rules while reducing taxable income. And for many retirees, simply having money spread across different types of accounts, some taxable, some tax-deferred, and some tax-free, can provide much more flexibility when it's time to create retirement income. None of these strategies are one-size-fits-all, and they won't be appropriate for everyone. But they all have one thing in common. They usually work best before the retirement triple tax bomb begins, not after. Because the biggest mistake isn't paying taxes in retirement. The biggest mistake is giving yourself fewer choices than you could have had simply by planning ahead. Age 73 isn't a deadline to panic about. It's a milestone to prepare for. And understanding how required minimum distributions can affect your taxes, your Medicare premiums, and even your Social Security benefits puts you in a much stronger position than someone hearing about these rules for the first time after they've already taken effect. If you found this video helpful, subscribe to the channel. Every week, I break down the retirement rules, tax traps, and Social Security strategies that can help you keep more of the money you've worked so hard to save. Thanks for watching, and I'll see you in the next video.